This is question number 1. Indicate by clicking on the relevant boxes whether the following statements describing the advantages and disadvantages of IFRS accounting standards are correct or incorrect, right? So let's start. Number 1. IFRS accounting standard improve comparability because they must be used by all listed companies worldwide. No, it's incorrect. Not by all. IFRS is not applied by all companies worldwide. There are countries who has not accepted IFRS yet. For example, United States. In United States, still they apply US GAAP. Okay, so this statement is incorrect. Number 2, IFRS accounting standards facilitate cross-border investment. Yes, correct. Why? Listen, the reason is this is the reason why in 1973 they introduced IFRS, because before 1973 all countries have their own accounting standard. So if there is an investor in India, he can only understand Indian financial statement. But now the Indian investor can also understand the financial statement of UK, Europe, so they can invest anywhere. So yes, it promotes cross-border investment. Number three, IFRS accounting standards are suitable for reporting entities for any size and type. No, no. The big book of IFRS is only recommended for big listed companies. For small companies, this big IFRS book is not recommended. Even in my lectures, I discuss this issue, because in order to apply IFRS, you need to hire some very senior accountants, and they may be very expensive, right? So it's not for all suitable for all companies. Yes, for small companies there are separate topic in SBR level we discussed, that is called IFRS for SME. IFRS for SME, right? Okay. Then IFRS accounting standards, they may be costly to implement. Yes, this is correct. I just told you that for IFRS you need to hire expensive accountant, right? Okay. So for some companies with low maturity level it may be expensive, but for very large organization with very big maturity level, for them they might not be such a big expense. But yes, they have written they may be. See the word maybe, so it's correct. Okay. Now this part, I would say for this part, you guys should read the book, or you guys should read the ACCA Study Hub material. Normally now it is recommended to read Study Hub material. Recently I have attended a UK conference, online conference, and they recommended to all students to read the Study Hub material and to practice on ACCA software, right? Okay. Now this is related, those who have read the book, this is related to how a new accounting standard is born. How a new accounting standard is born. So I'm sure if you have done F3 level, this is also an F3 booklet. There is one department which is called IFRS Advisory Council. IFRS Advisory Council. The purpose of Advisory Council, they spread the boys of Advisory Council are everywhere in the world. So they get the feedback from the world and they come to the International Accounting Standard Board and IFRS Foundation. They give their feedback. So if there is some major mistake in any accounting standard, or there is a major problem, so with respect to time, they give feedback, and then IFRS board, IAS board, they develop a new standard. So now read. The ISB follows a standard setting process when developing a new standard. What is the correct order of this standard setting process? Arrange the tokens below in order to from steps 1 to 4 of the process, right? Now, see, this is the consultation with IFRS Advisory Council. Yes. About adding a topic to the IFRS. Yes, this is the first. First of all, the most important thing is to get feedback from Advisory Council that what is the need of this standard, right? And then ISB put that thing in their work plan. Now, what is the second step? The second step is issue a discussion paper. This discussion paper is given, and then they get the feedback whether there is a need of this standard or not. Then if they get the green signal, then they develop the standard, and then they issue exposure draft. I would say this is the second last, almost second last step of standard. Exposure draft is nearly equivalent to a real standard. Okay, and finally when they issue the exposure draft, they get more feedback with respect to time. So sometimes they conduct a post implementation. See, the standard has implemented, the standard has been launched, and then now they are reviewing it. So this is the fourth step. Okay, so this is the order. I would recommend you to, for these areas, the best thing is reading. The best thing is reading. You must read. Now, next question. Greek company, a company with 31st December year end. The first important thing is the year end. Always mark the year end. For all financial accounting paper, the year end is very, very important. Decided to sell one of its buildings on 1st of October X8 and immediately started, see, decided to sell building. That means it is IFRS 5. IFRS 5, remember, held for sale, and yes, this date means on 1st October X8 they have decided. So the criteria of held for sale is going to meet on this date. Okay, and now we will be starting held for sale accounting just right now, and immediately started to market to sell it at fair value. A potential buyer has been found to purchase the building in its current condition. The building is ready for immediate transfer to the buyer as soon as price negotiations are complete, and the sale is expected to take place in early X9. So if you guys know, listen, if you guys know the held for sale criteria, all the criteria has been met. All the criteria has been met on 1st of October X8. On 1st of October X8. So my dear student, if the criteria is met, if the criteria is met, so from 1st October X8 we'll start held for sale accounting. Now how to do HFS accounting? Let me show you. HFS accounting, listen, we record it at lower of, at one end we write carrying value and the other end we write fair value less cost to sell. Remember, carrying value and the fair value less cost to sell. Now what they are saying, what is the carrying value? What is the carrying value at 1st October X8? It's 500,000. Let me write here. And the second thing, we are at 1st October. Okay, we are at 1st of October X8. The second thing we need to check is the fair value minus cost to sell. So fair value is 525. I'm talking about 1st October right now, not 31st December. And the cost to sell is this thing. So 525,000 minus 70,000. Okay, so this makes around, I think, okay, so 500,000 and this fair value less cost to sell is 455,000, right? Now we record it at lower off. So lower off is 455. Okay, and definitely there would be an impairment, but the examiner is not asking any impairment. So this is the lower amount. At 1st October X8 we are going to record this thing at 455. Now, but now what happened? Let me make a timeline. See, this is the 31st December X8 and this is 1st October X8. First of all, this is the date, the date of reclassification from non-current asset to current asset. But by the year end it is not sold. It's okay. Just 3 months. It is not sold. It's okay, but still it is held for sale. Still it is held for sale. Right? Okay. So again, now we have already recorded at 455. Now check what is the fair value less cost to sell at year end. What is the fair value minus cost to sell at year end? Let's see. Now at the year end the fair value is 505. The year end fair value is 505 and cost to sell is 70. So 505 minus 70,000. It's, I think, 435. Yes, 435. Okay, so there will be a further reduction in the fair value less cost to sell. So from 455 to 435,000, it's 1000. Okay, 435,000. Yes, there will be a further impairment, because why we are bringing it down, why we are recording it to fair value less cost to sell. The reason is, now there is no intention of usage. Now the only benefit we are going to obtain from this asset by selling it, so fair value is relevant. So 455 was the previous fair value less cost to sell, and now the current fair value less cost to sell is 435. So definitely we recorded at lower off. So 455 and 435, the lower amount is 435. So the answer is B. Answer is B. Read, what amount should be building be measured in Greek's statement of financial position at 31st December X8? So it's 435,000. It's 435,000. Please check it out. Please check it out. Take it as your final preparation, okay? Okay. So moving to the next question. Now, indicate for which of each of the following item listed below whether the expenditure should be included in the cost of inventory. Yes, it is IAS 2. Cost of inventory recognized in profit and loss in accordance with IAS 2. IAS 2. If you are a manufacturing organization, you know there are two disciplines you have studied in your cost accounting: absorption costing discipline and marginal costing discipline. Okay, that is cost accounting. Okay, but in financial accounting they follow absorption costing principle, absorption costing. And you know what absorption costing principle says? Listen very carefully, that you need to record your inventory at full production cost. Full, see the word full production cost. And full production cost means direct material plus direct labor plus variable production overhead and fixed production overhead. Okay, fixed production overhead share as well. So all production costs will be the part of inventory according to IAS 2. Okay, and now this MCQ is again linked to the theory, the book reading part, if you have done it. Listen, so an allocation of fixed production overhead based on normal. Yes, it is included in the cost, fixed production overhead, because all production overhead is part of cost of inventory. Yes. Now the second, abnormal amount wasted material immediately booked in the P&L. Abnormal cost, just like process costing. Abnormal loss, we only book normal cost in the inventory, normal cost, not abnormal cost. This is unexpected losses, immediately expense. And the cost of storage after completion of inventories, this is also booked in P&L immediately. This is also booked in P&L immediately. But yes, during the production process, if there is any storage cost, that goes in the part of inventory, right? Okay, so again this MCQ is linked to the book reading part as well. That's why I always recommend in my class to read book for IAS IFRS. Now the next thing is very interesting. It is linked to IAS 41, directly linked to IAS 41 and IAS 16. Remember the agriculture part. Now tea company grow tea bushes on its tea plantation. When the leaves from the bushes have reached maturity, they are picked and then dried using drying equipment. Okay, select the appropriate IFRS accounting standard that should be used to account for that should be used to Now let me give you a concept of bearer plant. In my normal course, I have also discussed this. For example, this is a tree, okay, and this tree is like a machine. Just think why IAS 16 we apply on bearer plant. This tree is like a machine. Every year you give water to this tree and sunlight, so this tree gives you fruits. This tree gives you fruits and you remove fruits. But the tree is still there. Tree is still there. Next year again the fruit comes or vegetable comes. You take out, you just remove the fruits, still the tree is there. So it's like a machine. You just input something in the machine, and every month machine gives you output. So on machine we apply IAS 16. On machine we apply IAS 16. Same is the case with bearer plant. On bearer plant we also apply IAS 16. Okay, so now in this question what they are saying tea company grow tea bushes on its tea plantation. When the leaves from the bushes have reached maturity, they are picked. Only leaves are picked, the bushes are there. They are picked and then dried using by drying equipment. Select the appropriate IFRS accounting that should be used on account for each of the components of tea company's tea plantation by matching the correct token to the correct component, right? Okay, now listen. First thing, tea bushes. Tea bushes is like this tree. Tea bushes is like this tree. Every year it's still same. When it is grown, it is still same. Only the leaves which is grown on this tea bushes, we remove that leaves, but the tea bushes is there. Okay, so tea bushes is like a machine. It's like a bearer plant, like a long tree. So on bearer plant we apply IAS 16. On bearer plant we apply IAS 16. Second thing, openly they are saying drying equipment. Drying equipment is like a normal equipment, machinery. On machinery we also apply IAS 16, but yes, there is some issue. Tea leaves at the time of picking. See, the leaves are there on this tree. The leaves are there on the bushes. So now I'm go in next 5 minutes I'm going to remove these. I'm going to remove these leaves. So just on the last moment when I'm going to remove these leaves, it's basically agricultural produce. It's basically agricultural produce. And agricultural produce we apply IAS 41. On agricultural produce we apply IAS 21. But yes, once these leaves are removed, from the tree and it is processed, then it becomes your inventory, and then it is IAS 2. Okay, so my dear student, how to solve it? Tea bushes is like a tree, a standing tree, and it will remain standing for many years. So it's bearer plant. IAS 16. Drying equipment is normal equipment, right? For the usage, also IAS 16. And tea leaves at the time of picking, at the time of removing from the tree, it's IAS 41, agricultural produce. Okay, so this is not the answer. Inventory is not the answer anymore. Now listen, next thing. Now this is linked to IAS 20. This is linked to IAS 20. Hope you guys have studied IAS 20. Listen to me. In IAS 20, you discuss two major things. One is government grant and the other thing is government assistance. Government grant and the other thing is government assistance. Government grant is the economic benefit provided by the government in the form of economic resources, something physically coming to you, some resources, some favor, which can be valued in monetary terms, coming to you. Like government give you cash, government give you machinery or something, a piece of land. All these things are government grant. But there is one thing which we call government assistance. Government assistance is also economic benefit provided by government, but not in the form of economic resources. For example, just giving you an example, there was a big competitor entering in your market, but government prohibited that competitor to enter into the market. Government removed it. So yes, this is the help by government. But it is not. It cannot be valued. So this is government assistance. Okay, and the treatment of government assistance is disclosure. Okay, so now let's see whether in this question, whatever we are getting from government, whatever we are getting from government is government grant or government assistance. Okay, let me enlarge the screen, read it carefully. Teach company received $3 million loan from its local government to assist with the expanding its business operations to build a privileged college, a private college. Okay, right? So government has given you a loan. Local government has given you a loan. So definitely it's something which can be valued. The loan has an interest rate of 1% and it is repayable after 3%. The prevailing market interest rate for similar loan is 6%. So just see, if you get these loan from the market, it's 6% rate. But if you are taking from government, only 1%. So the 5% is the favor. 5% interest rate is the favor. And yes, it can be valued. So it is government grant. It is government grant. And what is the favor? The favor is exactly 5% of 3 million. 5% of 3 million everywhere. It's the favor. Select the correct answer to describe the nature of the loan received and the value of the benefit received in accordance with IAS 20, government grant and disclosure of government assistance. Okay, so this is the first box. The loan received from the local government is considered to be government grant. This is the answer. It's not government assistance, it's government grant. It's government grant. I told you, because it can be valued. The second, the value of the benefit received. The second, see the requirement is the value of the benefit received is this 5% interest expense on the loan amount, everything. It's not 3 million. Loan we can get from anywhere. It's not a favor. The favor is the reduction of interest rate. The favor by government is the reduction of interest rate, reduction of interest. So 5% is the favor. 5% is the favor. 5% is the favor, right? Okay. Now the next thing, it's basically linked to IAS 37. You know, in IAS 37, decommissioning liability or compulsory disposal cost. This is same thing. Golden Company has purchased the land for its mining operations. Okay, the purchase date was this date is very important. The purchase date is 1st August X8. Okay, government legislation requires that Golden Company restores the land after a period of 5 years. Okay, so after 5 years you have to incur a compulsory disposal cost, and it is written legislation. That means that this is the legal requirement. Okay, so it is the legal requirement. Legal requirement means you have signed the agreement that after every 5 years you need to restore it. So yes, there is a present obligation, and yes, there is an obligating event. So you need to book compulsory disposal cost. Okay, and you know the entry for compulsory disposal cost. This is the entry. I am sure you know, PP debit, PP or non-current asset debit, and provision credit. PP, non-current asset debit, and provision credit. But yes, this entry is made on the present value, the today's value, present value. Remember, present value of the future cash flow. Now, at 1st August X8, this is the date, this is today's date. The cost to restore the land based on environmental expert is 180,000. This is the cost to restore the land in today's value. See, at first the cost to restore the land is 1, so it's already present value. This 180,000 is already present value, my dear students, because what they are saying, at 1st August 0 is, that means today, today's cost to restore. It's not future cost. Yes, if they would have given you the future amount, the future cash flow, then you need to calculate the present value. then you guys need to calculate the present value. But here you don't need to calculate present value, already present value is given. See, this is the game of words. This is the game of words. An appropriate discount rate is 6%. Golden company has a year end of 31st December. Okay, so this show started on 1st August x8 and your year end is 31st December x8. Your year end is 31st December x8. Now don't read the options. I'll first solve it for you. I'll first just see the question. Just see the question. I'll solve it for you. I'll solve it for you. So let's solve it. See this. This is your accounting period, 1st January x8 to 31st December x8. Very simple. It's all basic accounting. Even this question is not difficult. Okay. So on 1st August x8, first of all, on this date, you signed an agreement and you are liable to restore it after 5 years. So there is an obligating event. So first entry you will made PP debit, or you call it land debit. It's also land debit. You can also write the name 180,000 and provision credit 180,000. Okay. Now this 180,000 is already in this question. They have already given you present value. So on this date, the value of your loan is 180,000. On this date, the value of your loan is 180,000. Now see this: August, September, October, November, December, 5 months. So for these 5 months, you need to calculate unwinding of discount. Unwinding of discount. So let's use the rate. I think it's 6%. Yes, 6%. So 180,000 times 6% times 5 upon 12. 180,000 times 6% times 5 upon 12. Let me do it. $4,500. 4,500. So the entry will be interest expense debit and provision credit. Interest expense debit and provision credit. Okay, so now initially your liability was 180,000. Now it is increased to 4,500. So at the year end it will be 184,500. This is the value of liability at the year end. This is the value of liability at the year end. You can see the whole story now. This is the whole story of this question. The liability at the year end is 184,500. So this is the initial entry. This is the entry for interest expense, unwinding of discount, and this is the year end liability. This is the year end liability. Okay. Now let's, and you know, this type of compulsory disposal cost or this type of decommissioning liability is always capitalized. See, it is, I debited the asset. Don't forget these basics. I'm sure you all have attended the normal classes. See, now let's read. Which of the following statement is correct according to IAS 37? Provisions, contingent liabilities and contingent assets. Provisions, contingent liabilities and contingent assets. Listen, on 1st August x8, Golden Company should recognize a provision equal to the present value of the restoration cost and a corresponding expense. No. This provision is capitalized. Property, plant and equipment debit or land debit and provision credit. They are saying just book the expense complete amount. No. So this is wrong. This is big wrong. Plus the year end number is also wrong. Year end provision amount is also wrong. Okay. Now B. On 1st August x8, Golden should recognize a provision equal to the present value of the registration cost. Yes. And the corresponding debit entry to the land. Yes. Land or PP. Anything you can say. Land or PP. Yes. The carrying amount of the environmental provision is no. Again wrong. The year end amount is 190,800. You know why they are giving you 190,800? Because this 190,800 will come if you calculate 12 months interest. If you calculate 12 months interest, then this value will come. But we have to calculate only 5 months interest. Okay. Now see, on 1st August x8, Golden Company should recognize a provision equal to the present value of the restoration cost and a corresponding debit entry to the land. Yes, yes, land debit or PP debit, whatever you say. The carrying amount of the environmental provision is, yes, yes, this is the correct answer. C is the correct answer, you can see. C is the perfect answer, you can see. Okay, now the next one is IFRS 9. This is convertible loan notes. Convertible loan notes. You remember in convertible loan note there is the first entry bank debit. Remember loan credit and equity credit. This was the first entry of convertible loan note. In convertible loan note we used to split debt or equity. I'm sure you know this. Okay, so and this is like the day one, and then after some years you need to do unwind. Let's see. Indeed company issued a 20 million convertible loan notes on 1st July X3. In 5 years time, on 30th June X8, the holders can choose to redeem the loan. Redeem the loan means cash of 20 million, or to convert them into fixed number of ordinary shares. Yes, so it's a convertible loan note. Perfect. At 1st July X8, the present value of loans with similar terms without conversion options was 18.97. Okay, so if you do discounting, if you discount the future cash flows using the normal market interest rate, so it's 18.97. But how much cash you receive today? 20 million. So 20, and you know the liability element is 18.97 present value of future cash flows. So 1.03 is your equity option. 1.03 is your equity option, remember? So this is how we used to split. I'm sure you know, very, very famous standard. So on the day one we will make the entry bank debit 20, loan element is 18.97, and equity element is 1.03. Okay, now this is the day one entry. Now this equity will go in the fridge or freezer. It will remain as it is. Equity will remain as it is till next 5 years. But yes, this loan element is 18.97. Now you need to apply the same rate, the rate on which you did discounting. The rate on which you did discounting, you need to unwind. Okay, so gradually this 18.97 will increase, and it will stop to 20 million. It will stop to 20 million. If you have taken the classes, you know this 18.97 will gradually increase through interest expense entry, and gradually it will touch 20 million. So should I tell you one thing? If you remember, the difference between this 18.97 and 20 million is the interest amount. Interest expense amount, which will book gradually over 5 years. Over 5 years. I think this is 1.03. This is 1.03 will be booked over 5 years. Okay, right? And then in the end, on the day last, it will touch 20 million. The loan will touch 20 million, exact 20 million, right? And in the end, you have the option to pay cash, and the second option is the shares options. Okay, now let's read. On 1st July, which statements is correct in accordance with IAS 32 financial instruments presentation? Number A. At 1st July X3, Indeed company should recognize a liability of 18.97. Yes, I agree. If the loan notes are converted on 30th June X8, 18.97 is transferred to no. After 5 years, this 18.97, after 5 years, this 18.97 will become 20. See, this 18.97 will gradually increase. So after 5 years, it will be converted into 20 million. Okay, so in the end, it will be no more 18.97, it will be 20. Okay, So this is not correct. B. At 1st July X3, Indeed company should recognize an equity balance of 1.03 million. Equity balance of 1.03 million. Okay. Sorry. Wait. Okay. Equity balance of 1.03 million. Correct. This balance is subsequent. Oh, no. No. Very wrong. Big wrong. You never increase the equity balance. Equity, I told you, equity will go in the fridge. Equity will go in the freezer. We never increase the equity. This is perfect wrong. C. On 1st July X3, Indeed company should recognize a liability of 18.97. Yes, day one this. A finance cost of 1.03 million is recognized. Looks perfect. Looks perfect because this 18.97 will gradually be converted into 20 million slowly, slowly. Slowly, slowly, it will be converted into. So yes, a finance cost of 1.03 million will be transferred to, will be booked, right? And now D. On at 1st July X3, Indeed company should recognize an act. No, very wrong. Very wrong. So the answer is C, but one more explanation I would like to give you because there is one difference in this question. Listen. What I'm saying that the difference between this present value and the future 20 million is 1.03 and this is your interest expense. Yes, this is your interest expense because there is no physical interest in this question. There is no, read the question, there is no physical interest in this question. And when there is no physical interest, no cash interest every year, so the difference of 20 and 18.97 is your interest expense and which we need to spread over 5 years. So C is the most appropriate answer. Read it carefully. Okay. Sometime you can think, see, these are tricky question. A is also, sometimes some students say A is also correct. A is partially correct. See, in A they are saying on 1st July X3, Indeed company should recognize a liability of 18.97. This is perfect. If the loan notes are converted on 30th June X8, 18.97 is transferred to equity. No, this 18.97 will be converted to 20 at that time after 5 years. After 5 years, this 18.97 will be converted to 20 million. Okay, so we'll transfer 20 million liability to equity if if other guys they chose the equity option. Okay, right? So the answer is perfectly, answer is C. Perfect answer is C. Take your time. Take your time. Take this class as your final revision. Okay, it's your final revision. And one more thing, I have posted many classes on my YouTube channel. You can watch them on consolidation, ratios, final accounts, okay, different standards, lot of things are there. Now, okay, now it's consolidation. And which part of consolidation is this? The consolidation part is associate, you know, associates. And they are talking about P2A sale, P2A sale, right? And the holding is 35%. Now, one thing is very clear. I loudly say then this in my class. Listen, that what is the difference if you are dealing with subsidiary? If you are dealing with subsidiary and is there is an intercompany transaction, then you calculate URP, unrealized profit, and you pass the entry of complete URP in case of subsidiary. But in case of associate, first you need to calculate amount of adjustment. And you know what is amount of adjustment? Amount of adjustment is, listen, amount of adjustment is URP multiplied by your holding percentage, which is 35%. URP multiplied by holding percentage. In my class, I often say this, that in case of subsidiary, you make entry, you make adjustment of complete URP. But in case of associate, you first write URP and then you multiply by it by holding percentage. Then you multiply it by holding percentage, then you multiply it by holding percentage. Okay, now listen, parent owns 35% of it company. 35% means associate, right? Less than 50, more than 20. which gives significant influence. Associate. During the current financial reporting period, parent company sold inventory to kid company for 8,000 at a margin of 30%. So sold. So 8,000 is the selling price, and margin is always profit percentage on sales. At the year end, first calculate the total profit. Let's calculate the total profit. Total profit will be 8,000 is the selling price and multiply by 30%. So it's 2,400. First of all, this 2,400 is the total profit. Now next step is URP. At the year end, the inventory remain unsold. At the year end, the inventory remain unsold. So all the inventory is unsold. So complete profit is URP. So your URP, the second step, URP is also 2,400. See, if they would have told you that only 50% goods are unsold, then 50% profit will be URP. But as they are saying, all the product is unsold. So complete 2,400 is URP. Complete 2,400 is URP. Complete 2,400 is URP. Okay. Now the next thing is you have calculated URP. Now the next thing is amount of adjustment. Amount of adjustment is holding percentage is 35%. So URP multiplied by 35% is equal to 840. So in this question you will adjust only 840. Okay. Now one more dot they are giving you. They are saying parent company has recognized receivable balance of 8,000 for this sale and the kit company has corresponded. No, never. In case of associate, you don't cancel receivable and payable. Oh yes, in case of subsidiary, you cancel receivable of intra-group receivable or payable. You cancel only in case of subsidiary. In case of associate, you never cancel receivable and payable. Be careful. But yes, you adjust the URP with this amount of adjustment. Okay. So now let's read which statement is correct. The unrealized profit is 2,400. Wrong. We will not adjust 2,400. We will adjust 840. Okay. So the receivable and payable balances are cancelled in the no, not cancelled. The unrealized profit is 840. Yes, the amount of adjustment for relevant for us. The receivable and payable are cancelled. No, are cancelled. Are not cancelled. Don't need to cancel. The unrealized profit is 2,400. No. For this question, it's 840 is the unrealized profit. Now, the unrealized profit is 840, correct? And the receivable and payable are not cancelled. Perfect. For this question, the unrealized profit is 840. Next. Fit company owns 40% shareholding in dot company, which gives it significant influence. Again, Fit company is parent and D company is associate, 40% holding. Okay, which gives it significant influence is associate. During their Fit company sold P2SC, Fit company sold goods to at the year end still holds some of these goods. So yes, you need to do URP adjustment. Okay, and this is the question of income statement. Just think income statement. So let me explain you. When there is a P2A sale, so the URP is booked by P company. URP is booked when P2A sale, URP is booked by P company. So URP is present is in P company's income statement. URP is present in P company's income statement. So now if you want to remove URP from P company income statement, you need to adjust the cost of sales. You need to increase the cost of sales. So when you will increase the cost of sales, the entry will be cost of sales debit, cost of sales debit. Okay, right? And now the second step. When P company sold inventory to URP and A company did not sold it to third party, so that means there is some unrealized profit in A company's inventory at the year end. There is some unrealized profit in A company's inventory, but you know the rules of consolidation. Listen, we never add A company's inventory with us. We never take in adding together A company's inventory. So we have only one asset. We have only one asset of A company in our book, and that is investment in associate. That is carrying value of investment in associate. So we'll credit that carrying value of investment in associate. We'll remove URP from investment in associate, right? So this is the entry of P2A. This is the entry of P2A. So answer is this and this. Answer is this and this. Cost of sales debit. Let me write here. And yes, if it is A to P sale, then you remember share of profit of associate. Then associate share of profit will be adjusted if you know the rules. Next, 12. Very good. IAS 21. IAS 21. Let me give you a quick recap. Listen. Monetary and non-monetary. Monetary and non-monetary. Definitely see, these are revision classes. You must have done the standard before. Okay. Monetary items are cash. Monetary items are cash or amount to be received or paid in fixed determinable amount of money. So cash and receivables and payables are monetary item. Cash and receivable and payable are monetary item. What is the treatment of monetary item in IAS 21? Listen. At the date of transaction, you will record it at the exchange rate. You will record it at the exchange rate of the date of transaction. Now, at the year end, you need to retranslate your monetary item to the year end exchange rate, and any exchange gain or loss, on monetary item will go directly in the P&L. Any exchange gain or loss on monetary item will go directly in the P&L, okay, right? Next, non-monetary items are like IAS 16 assets, IAS 2 assets, right? IAS 38. These all are non-monetary items because they are not cash and there is no amount to be received or payable in fixed and determinable amount of money. So for non-monetary item, at the date of transaction, you record it. You use the exchange rate of date of transaction when you are buying. Date of transaction exchange rate, okay? And if you are using cost model, first case, if you are using cost model, you are not going to revise the exchange rate in future. You are not going to revise exchange rate in future. But yes, if you are using revaluation model, something extra I'm teaching. If you are using revaluation model for non-monetary item, then first you need to record it at the date of transaction exchange rate. At the date of transaction, use that exchange rate. And at the year end, if you are doing revaluation, then you need to calculate fair value in the foreign countries amount, and then you need to book, you need to convert it into your local currency using the exchange rate of the year end. And now apply normal IAS 16 or normal IAS 40 or whatever accounting standard you want to apply. Normal rules. Okay. I know this last part is a little advanced. I will say this in the next question. Okay. Because next question is also linked. Next question is also linked to IAS 21. Don't worry. Listen. Beaver Company, listen, Beaver Company has a year end of 31st December X6. It entered into the following foreign currency transactions in the current year. Listen, transaction number one, 25th of October X6. Beaver Company bought inventory denominated in a foreign currency. Bought inventory is IS2 and it's a non-monetary item. Inventory is a non-monetary item. Be careful. At the year end, inventory has been sold. However, the supplier has not been paid. So it's about payable. They are talking about the payable. Yes, payable is a monetary item. Payable is a monetary item. I agree. Inventory is a non-monetary item, but payable is a monetary item. Okay. Now, wait. Now come here. Indicate which of the options are correct in accordance with IS 21 foreign currency transaction. The trade payable is a monetary or non-monetary? Yes, it's a monetary item. They have written asset, but it's a monetary item. You should say monetary item. Okay. Although it's a liability, but it's monetary. Okay. It's not at all a non-monetary. That's why I'm not picking that option. Now, the trade payable. See, the trade payable. We got the loan on 25th October X6. And we have a year end. We have a year end of 31st December X6. See, we got the loan, we bought the inventory on credit on 25th October X6. That means the trade payable arises on 25th October X6 and the year end is 31st December X6 and still this is not been paid. So yes, monetary items, listen carefully, monetary items need to be retranslated at the year end exchange rate. Yes. So the trade payable is, this is the answer. The trade payable is retranslated at 31st December X6. Okay. Now let's do the transaction number 2. Let's do the transaction number 2. On 1st July X6, Beaver Company purchased equipment to be used in its operations, paying in a foreign currency. The equipment is measured using, thank God, easy cost model and depreciated over its useful life for 5 years. Very easy. How to, if you have bought a equipment means IS 16 asset, non-monetary asset. So non-monetary assets are recorded at historic rate. Historic rate means the date on which you bought it, use that exchange rate. And once you have converted into your currency, now just sleep. Now simply apply IS 16. No need to revise any exchange rate or any exchange gain or losses, nothing. So the equipment is a non-monetary asset. Okay. And do we need to retranslate this non-monetary item at year end? Not at all. No need to retranslate it at the year end. This retranslation is done only for monetary item. Retranslation is done only for monetary items. Okay, now the next question is also linked to the last one. Again, Freddy company purchase a building. Building is again non-monetary. My dear students. Paying for it in a foreign currency. Okay. The building was classified as investment property, IS 40, and they are using fair value model. Now, relax. For example, just giving you imaginary numbers. 1st January X8, this is the starting and this is the year end. Okay, listen how we play with this. First of all, let us say you bought it for 5,000 pounds. 5,000 pounds, this is the cost at 1st January X8. Okay, and the exchange rate with for pound to dollar is 1.2. 1 pound is equal to $1.2. See, this is the rate. This is the rate. I'm giving you example. 1 pound is equal to $1.2. Now, if you are active, so 1 pound is equal to $1.2. So if I convert it into dollars, more dollars will be there. So multiply it. So 5,000 multiplied by 1.2 is equal to $6,000. So initially it will be recorded at $6,000. Let us say dollar is our currency. Let us say dollar is our currency. Now, what will happen? At the year end, as we are using fair value model, so this is the requirement. This is the requirement of IAS 40 to bring investment property to fair value with changes taken to P&L. So first of all, at the year end, you will calculate fair value in foreign currency because this property is like in UK. We are in United States, but this property is in UK. So first of all, go to UK and calculate the fair value of this property. So let us say the fair value is 8,000 pounds. 8,000 pound, but now the exchange rate at the year end is equal to 1 pound is equal to $1.3. Okay, $1.30. Now what you will do, you will convert this fair value at the year end using to your own currency, which is dollars, but use the rate at the year end. Use the exchange rate at the date of revaluation. So 8,000 multiplied by 1.3 is how much? Let me tell you. 10400. This is the fair value in dollars. Now it is in dollars and it is in your country. Okay, now simply apply IAS 40 on these two. IAS 40, and IAS 40 says all changes in fair value to be taken to P&L. So from 6,000 to 10,400, your entry will be, see, investment property debit from 6,000 to 10,400 is 4,400. And okay, so now I have given you a practical example. Now read the lines. Since the building was purchased, its fair value has increased and the exchange gain. See, the fair value is also increased from 5,000 pound to 8,000 pound. Yes, and the exchange rate is also favorable for us. So there are two things. One is fair value gain. One is fair value gain. The other is exchange gain. Everything will go in the P&L. Everything will go in the P&L. See, I have converted in my local currency and everything goes in the P&L, right? Once you convert it in your local currency, then you apply normal your accounting standard IAS 40 or IAS 16 or IAS 16 if it is a owner occupied property. So now what they are saying, the increase in which of the following options is correct? The increase in fair value and the exchange gain should be yes. This is the answer. A is the answer. Both will go in the P&L. Both will go in the P&L. Yes, because of IS 40. Yes, because of IS 40. Now read the second line. The increase in fair value and the no, not OCI. Wrong, wrong. The exchange gain should be no. The fair value gain should be recognized in no. Once you convert it in your local currency, now simply apply the local accounting standard, and that is IS 40. And IS 40 says all changes goes in P&L. So answer is A. This is normally a non-routine question they have given in the mock. It's a non-routine question. We teach this in SBR, Strategic Business Reporting course as well, this thing. So they have made us a little difficult mock this time. Okay, number 14. Thirsty Company manufactures Quench branded soft drinks. The brand was purchased from a competitor during the current year. Thirsty Company management believes that the Quench brand will contribute to the net cash flows of the entity indefinitely. That means indefinite life. Indefinite life. Okay. So hope you remember intangible asset. Intangible asset with indefinite life. Remember intangible asset with indefinite life. With indefinite life. Just listen to me. If you know the IAS, no more amortization in this case. No amortization. Yes, you do impairment testing at least annually, number one. Plus, if in the mid of the year or after the quarter you get an impairment hint, either you get impairment hint, then you do impairment testing, and if you are not getting any impairment hint, then at least at the year end, at least annually impairment testing is must. This is the rule, okay? And no more amortization or depreciation. Now start. Which of the following requirement reflect the correct accounting treatment for the brand? Number A, amortize the brand over the max. No more. Indefinite life. Why are you using 10 years? No such thing. Do not amortize the brand but review the useful life if there is evidence that it has changed and test for no need. No need to review and test for impairment if indicator exists. This is also wrong. At least annually impairment testing is also must. At least annually impairment testing is also must. And yes, this is also written that every year if the life estimation is possible, like on the day zero, the life was indefinite. But after 2 years, the expert says that yes, the finite life can be calculated. Yes, from the day the finite life can be calculated, you start your amortization. Okay, but this B statement is not completely correct. The remaining half is wrong because with impairment testing, sorry, with intangible asset with infinite useful life, at least annually impairment testing is also must. C. Amortize the brand. Never. With indefinite life, no amortization. Now read. D. Obviously, one first three is wrong. The fourth one is correct. Do not amortize the brand and test for impairment annually. Yes. And whenever indicator exists. Yes. This is the perfect. Annually is must. And if in the mid of the year you get impairment hint, then again it is must. Impairment testing. So D is the perfect answer. Okay. Question number 15. This is linked to EPS. This is linked to EPS. Let me explain you. Like if you have 2 years, this is 2007 and this is 2000. This is December X8 and this is December X7. Now let me write the profits. The profit for December X8 is 95,000 and this year is 160. Okay. And now calculate the number of shares. Wait. Number of shares. This is the share. See, equity share at the rate $2, and this is also dollar. So this is the share. This is share capital. Listen, student. This is the biggest dodge. Always, listen. Pause the screen. Pause the class. Wait. Always recognize that in the question, share capital is given or number of shares is given. These are two different things. Share capital is in dollars, but number of shares are numbers. Okay. So in this question, dollar, here it is written dollar. So this is share capital. Okay. So how you calculate number of shares? Let me explain you this formula. Number of shares issued. Whenever you need to calculate number of shares issued, you write ordinary share capital in dollars divide by face value. So your face value is $2 and your share capital is 50,000. So 50,000 divided by 2. 50,000 divided by 2 is 25,000 shares. So last year the number of shares issued were 25,000 last year. Okay. And in the current year, which is X8, this is 200,000. See, 200,000 divided by face value is 2. $200,000 divide the face value is 2. So now the shares are 100,000 shares. Now number of shares are 100,000 shares. Okay. Now student, use your common sense. Use your common sense. Previous years the number of shares were 25,000. This year it's 100,000. So purely a blind man can also see there is an increase. There is an increase, or there is an issued new shares of 75,000. Somebody issued new shares, company issued new shares of 75,000. You can see. Now which type of share issue is this? Which type? There are three types of share issue: full market price issue, then bonus issue, and then right issue. Full market price, bonus, and right issue. Let's see. During 2008 there was a bonus, only bonus issue. There is no other shares were issued. So that means pure bonus issue happened. And you know one thing, listen, whenever old thing, normally I teach IS 33 in my first class. It's my favorite standard. I teach IS 33 in my very first class. So whenever there is a bonus, see, there is a bonus issue in this year. Whenever there is a bonus issue in this year, so you restate last year EPS as well. Now, whenever there is a bonus issue in December X8, like 2008. So now when you are showing the 2008 accounts to your shareholder, you will show a comparative EPS of last year comparative EPS. And in that EPS, you will take the impact of bonus shares, updated bonus shares. Okay. But yes, in calculating the last year EPS, you will use the profit for last year. You will use this profit. So read the requirement. Complete the sentence below. In accordance, this is the requirement. Read very carefully, please. This is the last question of today's class. In accordance with IS 33, in accordance with earning per share, the basic EPS in 2007 presented as a comparative the 2008 financial statement. What does it mean? That means when you are presenting the 2008 financial statement, you will show the last year comparative EPS. Okay. So how to calculate last year comparative EPS? The profit will always be used for last year, which is $95,000. But the number of shares will be updated. These updated number of shares, which contains the bonus issue, will be used. So 100,000 shares. So this will be 95 cents per share. This will be 95 cents per share. This is the answer. I am sure you guys remember. But yes, as a student, you may ask, sir, when you taught us complete IS, you taught us bonus fraction and many things. In this question, you cannot calculate bonus fraction. Why? Because they have not given you the bonus percentage, and also directly the shares are given. Directly number of shares are given, so you can directly take the impact through shares. I hope you learned something new. Yes, there are some questions were tricky. ACCA body makes a tricky type of pre-mock. So if it is a little challenging, and if you are working hard, so in the exam you can easily perform. Okay. And I'm also recording more classes for pre-mock. So stay in touch with this YouTube channel, and you can also subscribe this YouTube channel. You can also share this video with your friends. Okay. And if you learn something new, please comment on this video, right? It's a tip from your side. Thank you and take care.